Hey guys, one-on-one with Jon Steingraber here. Super excited about today's episode. Today we're gonna be talking about taxes, how to save money on taxes, 401ks, IRAs, breaking it all down. This is what you should have learned in high school, right? You should have got this a long time ago. If you're watching this, you have kids, or if you're a teacher, you're probably gonna wanna use this episode in your math class. You're gonna want to share this with other people. So show me some love. Tell me what you think. I'm gonna be breaking down everything on taxes. It's gonna be super exciting. If you're a business owner, I'm gonna show you how to save a ton of money. And I've done these presentations around the whole country. I've spoken to hundreds of thousands of people teaching them this. And every time I teach these classes on stage, people are just amazed at how easy taxes really are, because we've been taught or programmed for some reason to believe that taxes are complicated. They are not complicated. They're actually really, really easy. And look, here's the deal. Who knows about the tax law, right? Who knows about the tax laws? You have accountants and then sometimes people that are very high income earners, right? If you're a high income earner, you typically know about taxes because you're sick and tired of paying so much, right, in taxes. And that's kind of what happened to me. I was fixing and flipping a lot of properties, making good money, and I realized how much money I was giving to the government. And I was thinking, man, like, where does this money go, right? Anytime you donate to like a nonprofit, if you sponsor a kid, right? Or, you know, those commercials that you see on TV, they like let you know what's going on with the money. But not once have I ever gotten a statement from the government, right, explaining to me what they're doing with our money. So it's our legal right, as citizens of the United States of America to reduce our taxes to the full extent of the law. So today, I'm gonna educate you a little more on that. Why? Because unfortunately in school, in college and things like that, they might not want you to know, right? They didn't make it part of the curriculum maybe for a reason, right? Public schooling, you know, the government might not necessarily want us to know everything about how taxes work. So I'm gonna really introduce to you guys some really, really good stuff. And I think you're gonna get excited about it, you know, believe it or not. Taxes aren't the sexiest thing in the world, but I think you're gonna get excited about saving a lot of money. So the way that I'm gonna break this down, first I'm just gonna give you a quick introduction, right? On kind of who I am. My name is Jon Steingraber. I've been a national trainer for many years now. I'm a real estate investor. If you're tuning in for the first time, follow me, subscribe to my videos. I teach about home ownership, you know, tax reduction strategies, motivation. I interview people. So we've done a few episodes recently, and those videos are right on the site. So subscribe to YouTube, like this, share it, comment. We want to engage with you guys, okay? So, you know, if there's anybody that you think should learn about this, please tag them in the comments as well. And feel free to share this on your site if you have one, or on your Facebook page. That's a little bit about me. I also run a brokerage, Signature Realty NJ, right here in New Jersey. And I'm an investor. I buy houses, I rent them out, you know, and do some other things. So do a lot of trainings and workshops. We do first-time homebuyer seminars. We do passive income workshops. We just had an awesome one on Saturday, had 143 people there. And I run a real estate club. So if you're in the New Jersey area, you know, visit our site at njresn.com. So let's jump into this. I'm excited about this. Hopefully you are. So hey, turn your phone off, right? Tune in with me, because we're gonna be doing some numbers. Even though they're simple, you got to stay focused. So we're going to do this by showing you a case study, okay? So I'm going to use my pad over here. We're going to switch the screen over so you can kind of see what's going on. And you're still going to be able to see me up here in the corner. There we go. Is that all right, Joey, if we do that? Yep. All right, cool. So let's take a married couple, right? You have a married couple, and they have 2 kids. Right? And the reason I'm going to do this, even if you don't have 2 kids or you're not married, I'm going to do another scenario in a little while so you guys can see how it works. And I'm going to break it all down for you. I think in this video, when you're done, you're probably going to know more about taxes than 90% of the population. So let's say that this couple each makes, right? Let's say each person makes $60,000 a year. Okay? Just as an example. So total, they make $120,000 in household income. Okay, so the first thing that you do with taxes is you add up all of your income, right? All of your sources of income. Now, this person doesn't have any, rental properties or anything like that. If they did, we would have to add all the rents up and then add it to their W-2 income. They both have a job, so they both get W-2s right at the end of the year, so they make $120,000 for the year. So the first thing that we're going to do is a lot of people think that you have to pay taxes on all of your income, and that's not true, right? So there's something called deductions, okay? There's something called deductions. And the IRS allows us to deduct from the income that we make. Now, there's two ways of doing this, okay? Number one is you can itemize your deductions, okay? Itemizing your deductions is really good for business owners and people that spend a lot of money on tax deductible expenses. And I'm going to give you a couple resources for you guys to go on a website with the IRS that basically explains what deductions you're entitled to. But for the majority of the population, right, and I'm going to do this video for the majority, you have what's called the standard deduction. The standard deduction is basically a fixed amount that the government says, hey, you don't have to pay tax on this amount. So if you look at the screen over here, we have, if you are single, right? If you're single, I want you to comment in the comments and just say, I'm a single filer, right? If you're married, okay, then you get double, right? If you're single, you get $12,200 tax-free. So your first $12,200, you do not have to pay tax on. So if you only make $12,200 for the year, you don't have to pay any taxes to the federal government for your federal taxes, okay? You still have to pay Social Security and Medicare, and maybe you have to pay state income taxes, okay? If you're married filing jointly on the first $24,400, you do not have to pay taxes. So this couple example that we're showing, right? Let's go back to the couple example. We have $120,000 that they're making, right? And we're going to subtract their standard deduction of $24,400, right? So let me grab my calculator real quick. So we have 120,000 minus 24,400, and we are left with 95,600. 95,600. So that's the first step. You add up your income, then you subtract your deductions, right? In this case, we're just using the standard deduction. Okay, and what does that mean? Like, let's say you have a big mortgage, right? And you pay, I don't know, $4,000 a month on your principal and interest, right? Not your taxes and insurance. About $3,000 out of that $4,000, right, is going to be interest, and that's tax deductible up to the first $750,000 of your mortgage. So let's say you have $3,000 in interest that you pay per month times 12, that would be $36,000 in deductions that you're entitled to. So you would not take the standard deduction, right? You would itemize all your expenses, right, and then add those up. So if you're in that scenario, you're going to be able to deduct a higher amount. I'm just trying to keep it simple, okay? But that's how itemized deductions work, and you're entitled to a lot of them, okay? So you're at $95,600. This is, right, your adjusted gross income. All right, guys, so we calculated our adjusted gross income, right? So we have a couple that makes $120,000, right? We took off their deduction of $24,400, right? And now we have, let's see here. Now we have to calculate our contributions to our retirement accounts. So you're allowed to put money in an IRA, 401k, or any other retirement account that you're part of. So the way that it works is you're allowed to put money away in these, and there's a limit to that. So let's look at what the limit looks like, right? So check this out. If we go to this shot right here, in an IRA in 2019, right, this changes every year. 2018, it was $5,500. In 2019, it's $6,000. And if you are over 50, right, if you're 50 or you're older, you are allowed to put $1,000 more. So I'm allowed to put in $6,000. If you're 50 or older, you can put in $7,000. And in a 401k, right, you're allowed to put in $19,000 as an employee, and then your employer is allowed to put more money away. So we're going to keep it super simple with this case study, and we're going to just contribute to the IRA, right? So you have $120,000 that they made, right? We subtracted the $24,400 in standard deductions, right? And then we're going to subtract another $6,000 that they're putting away in their IRA, right? So let's do the numbers. So we have $120,000 minus $24,400 minus $6,000, right? Because the way that it works is, guys, this money that you're putting away in the IRA, this money, you pay taxes on it later. It's not tax-free, it's tax deferred. Meaning if you grow this $6,000 in the future, right, 20 years from now, right, you're allowed to take it out when you're 59 and a half years old, right? So when you take it out, that's when you're gonna have to pay taxes on that money. So the government gives you a tax write-off now for that and allows you to reduce your taxable income by the amount of money that you put into your IRA or 401k. So now we have $89,600. This is what our taxable income is. This is the taxable part of our income, right? Pretty simple, right? You take your gross income, you subtract your standard deductions, and then you subtract your contributions to your retirement account. That will give you your taxable income. Then you take this number, the $89,600, and we're gonna go back to the tax brackets, okay? Now, I don't wanna lose you here. I want you guys to understand. Now we're looking at the bottom here because this is a married couple, right? The case studies for married. If you were a single person, individual, you would use this one. We're gonna use this one over here. Now, I want everybody to understand how this works. If you make $1 million or if you make $100,000, you're gonna pay the same amount of taxes on your first bracket. Your first bracket is $19,400. Right? So you have to pay 10% on your first $19,400. That's whether you make $20,000 or if you make $2 million. On the first $19,400, you pay 10%. A lot of people think that you have to pay whatever your highest tax bracket is on all of your money, which is not true. Okay? Let me explain. So we are on $89,600, right? So that would put us in the 1, 2, 3rd bracket here, which is 22%. But look what it says here. You have to pay 22% on the amount over $78,950. Why? Because you already paid, or you're calculating it, you're gonna pay 12% on your money between $19,401 and $78,950. And before that, you had to pay 10%, right? So if you add what you had to pay in this bracket and this bracket, you have to pay $9,086. So to simplify this for everybody, if you made $78,950, you would have to pay $9,086 to the federal government in taxes, right? But because you made a little bit more, you made $89,600, we have to calculate the difference between $89,600 and where we left off paying taxes, right? So you take $89,600, if we could zoom in here, Joey. You take $89,600, right? And then you subtract $78,000, right? $950. Oh, I did that wrong. $89,600, yep, minus $78,950. So we are left with $10,650. So that's the money that we have to pay 22% on. On everything else, we paid 12% in taxes, right? And 10% in taxes. Now we have to pay 22% on this number and then add it to the $9,086 that this table already calculated for us. So then you just multiply times 0.22, which is 22%, and that'll give you a $2,343 number, $2,343. And now we're gonna add the $9,086. So we have a total tax burden of $11,429. $11,429. So let's go back. So to recap, we had a gross income of $120,000, right? We subtracted our standard deduction of $20,400, and then we subtracted our $6,000 IRA contribution, right? That gave us an $89,600 number in taxable income. Pretty simple stuff. Okay, once we went to the federal brackets, it told us that we will owe $11,429. That's our tax bill. Okay, now there's one thing that you might not know of. Okay, if you have kids, you are allowed to deduct $2,000, right, per child off your tax bill. That's called a tax credit. Now, of course, there's exemptions and, things like that for this. But for this couple making $60,000 each at 120 with a taxable income of $89,600, they would qualify for both kids' tax credits, right? So how much money off their tax bill do they get? $4,000. So although their bill is $11,429, we get to subtract another $4,000. So let's subtract $4,000, and their actual tax bill is $7,429. Now, it's interesting because their total income was $120,000, right? They only had to pay the federal government, right? Their federal tax, they're $7,429. So if you take the $7,429 and you divide it into $120,000, that's what they made, and then you multiply times 100, it'll tell you what they paid in taxes. They paid 6.19% in taxes. Not bad, right? So it's interesting. So 6% in taxes, right? They're on the 22% tax bracket. Now, how many people, if you stop them on the street, do you think that fit this category, right? Married couple with 2 kids that make 60 grand each. If you say, hey, what do you think you pay in federal taxes, right? They might say 30%. They might say half my money. In reality, they only pay 6% in federal taxes. Now, they also have other taxes, right? On your paycheck, you have unemployment tax, you have family leave tax, you have all these little taxes, right? And they add up, but it's not a whole lot, right? Then you have Social Security and Medicare taxes, okay? That's the one that I want to go into so you guys can understand how that works, okay? Now, I want you guys to comment on this because I think a lot of people think that our government has like such a high tax rate. And in reality, this couple's only paying 6%, right, in federal taxes. That's it, just 6%. Now let's I want you to comment what you think about that. And I know, a lot of people are like, well, wait a second, why do I pay so much money in taxes? Well, maybe you're not contributing to your retirement account. If this person contributed more than $6,000, right, to their IRA, they could actually get this tax down, right? Because they paid $7,429, but they didn't max out their contributions. They can technically put in another $19,000 away each, by the way, each, right? Each. So like if we broke this down, right, each person, I changed the color here. Each person, right, let's call it a husband and wife, right? Each person's allowed to put in $6,000 in their IRA, right? And each person's allowed to put $19,000 away in their 401k. So if we add this up, that's $25,000 here and another $25,000 here, right? That's $50,000 plus, right? They get to deduct their standard deduction of $24,400. So if you add all this up, they really are entitled to $74,400 in deductions off their $120,000 in income. So if you take $120,000, right, and we subtract $74,400, that's only $45,600 in taxable income. So this person can obviously legally manipulate how much money they pay in federal taxes. They can make it go down. Now, some people are saying, yeah, but this couple only making $120,000 a year with 2 kids and paying the bills and the mortgage and the taxes and the insurance and all this stuff, they don't have that much money to put away. I know that. They don't have $25,000 each to put away because they're living at their means, right? If they make $120,000 a year, right? They're spending $120,000 a year. How do they have more money to put away in a 401k or IRA? They don't, right? So if you live below your means, or let's say next time this person gets a raise, right? If these people get a raise, they don't increase their lifestyle. What they do is they put more money away to their 401k or IRA, for example, right? That way they don't have to pay tax on that extra raise that they got. So anyway, there's a legal way to basically manipulate how much money you're going to pay in taxes. That's how that works. So now let's go to Social Security. So Social Security every year comes out with a fact sheet, right? So you could Google it, 2019 Social Security fact sheet, okay? Now, I'm going to break this down, but if you look right here It says employees have to pay 7.65% and self-employed individuals have to pay 15.3%. Okay? And it's maxed out for Social Security, right? Social Security, look, right here. Once you make over $132,900, you don't have to pay any Social Security anymore. Okay, so let me break this out for you so it's simple for you to understand. Because it's really easy. Social Security, right, is 12.4%. Medicare, right, is 2.9%. If you add these two together, it's the 15.3% that you saw on that sheet, right? That's how it works. Now, your employer pays for 7.65%, and then you pay for the other 7.65%. If you are self-employed, you pay the whole 15.3%. Now, the downside of Social Security and Medicare is that it's calculated off your gross income. You know how that couple, the case study that we're doing, they made $120,000, but then they only had to pay taxes on $89,600. Well, in Social Security, unfortunately, there is no deductions, right? You're not deducting off your income. Whatever you made, if you made $120,000, you have to pay on that. Now the cap, right, just like I just showed you, is like $134,000 and change, right? So if you make $200,000, you only have to pay Social Security, right, the 12.4%, right, on that let's just call it $135,000, right? If you make $200,000, you still pay the same. You pay 12.4% on the first $135,000. On the other $65,000 that you made, right, you pay zero Social Security, right? But you know, if you cap out how much money you can pay on $135,000, right, 12.4% is $16,740, right? $16,000. Imagine paying $16,000 into Social Security in 1 year, right? Divided by 12, that's $1,395 a month paying into Social Security for your whole working life. Most people start working at 20 years old, right? And they stop working at about 69, 70 years old. So for 50 years you're paying into Social Security, right? If you're paying $10,000 to $15,000 a year into Social Security for 50 years, you're paying $500,000 to $750,000 into Social Security. That's a lot. That's a lot of money, right? If you're an employee, you only pay half that, 7.65%, right? So that's better. So let's use one of the examples, $60,000, right? Right? Let's call him, let's call him John. He makes $60,000. He has to pay 0.0765%. So look, he pays $4,590 in Social Security, $4,590. And then his wife has to pay another $4,590 if he's employed. If he is self-employed, it works different. Okay? I'm going to get into that in a little bit. But let's stick with the case study just for a moment, okay? Let's go back to what they paid in federal taxes. What they pay in federal taxes. Okay? Because they had the two kids, they had to end up paying $7,429. Now, they have to pay 7.65%, right, of $120,000, right? So we take $120,000 times 0.0765, and they're down $120,000 times 0.0765. They have to pay $9,180 to Social Security and Medicare. Guys, everybody pay attention to this. They're paying more money to Social Security and Medicare than they're paying in federal taxes. It's crazy, right? Plus $7,429. Now, the good thing about Social Security is that it's supposed to be for your benefit, right? Is their total. It's supposed to be for your benefit. What does that mean? That hopefully you'll be able to take advantage of Social Security, right, after you're 62 or older. That's when you're allowed to start getting Social Security benefits, right? Unless you're disabled, right, or you have survivor benefits or something like that. The downside of it is in this couple, right, like if you have John and Michelle, right, if we both paid into Social Security our whole lives, let's say I passed away, right? My wife would have to choose between her Social Security benefits and hers. She only gets one, right? My Social Security benefits and hers. So you only get one. The other one just goes away. The government keeps all your money. It's the craziest thing in the world. It's a forced retirement savings plan that we have to put money away, but we don't really own that money. That money's not there. If you both pass away, right? If you both pass away, there's only going to be a one-time check that's paid to your kids, which is called a survivor benefit. And that's if they're under 18 years of age. So if we were in a car accident and we both passed away, all the money that we put into Social Security, gone. Medicare, gone, right? So that's how that works. It's kind of frustrating, right? If you want to learn how to reduce your contribution to Social Security and Medicare, stay tuned because I'm going to be doing that a little bit later in this video. It's going to be awesome. I teach business owners this all the time and it's amazing, okay? So look, here's your federal tax that you have to pay, and here is your Social Security and Medicare. What do you guys think about this? Pretty unbelievable, right? So that's $16,609. So now let's divide that money into their gross income and multiply times 100 and see how much money they're paying. Look, 13.8% effective tax rate with their federal and with their Social Security and Medicare. So they're paying 13.8%. So their tax bracket was 22%. They're still not paying 22%. Total, they're paying 13.8%. And can they pay less? Yes, if they contribute more money to their tax-deferred accounts, right? Their 401k. Social Security and Medicare, if you're an employee, it's going to be tough to get out of paying Social Security and Medicare. There's not really a way to do that. You know, they take it right out of your check and there's no deductions on that. Okay, that's just how it works. So that's 13.8%. What do you guys think about this? Almost 14%. Then they have to pay state income taxes. Now, I'm not really going to get into this deep. Why? Because you guys are watching this video, you might be from different states. Okay, in New Jersey, the highest tax bracket is 10.75%. So let me write down their total tax burden is $16,609, which is 13.8%. That's without state income. If you live in Florida, you have no state income. If you live in Texas, you have no state income. If you live in Delaware, you have no state income, right? If you live in Nevada, you have no state income tax, right? Unless you're a corporation. Some of these states have corporate taxes, right? But as far as individuals, personally, you don't pay any state income tax. Pretty good stuff. Now, in New Jersey, the way that it works, there's actually a graduated tax table. Right? So you guys can Google this for yourself. And if you look at the top here, it says New Jersey tax rate schedule, right? This is 2018, 2019. I couldn't find it on the internet yet, right? So you can talk to your accountants about that because you don't really need to do it yet. That's why it probably didn't come out yet. So whatever it is that you make, right, in taxable income on your line 40, right? Because there's different deductions that you're allowed to take. If you make $120,000 in gross income, right, you're not going to end up at a taxable income of $89,600 for the state. Why? Because the state doesn't have that standard deduction of $24,400 for married couples. That's not how it works. So you're going to have a higher taxable income. So let's say instead of $89,600 in taxable income that we use for the federal tax brackets, let's say the state of New Jersey, you only have $100,000, right? Because you're allowed to deduct up to $10,000 of your property taxes as an example. Right? So let's say, you know, and then another 10,000 for something else, let's assume. So you're at 100,000. So you would just go over here, right? Between 75,000 and 500,000, you're going to put it here. So you're going to pay 6.37% in taxes. And then you're going to subtract this number here. So if we want to use 100,000 for this case study, right? We would take 100,000 times 0.0637, right? And then we're going to subtract, right here it says subtract $2,126.25. So you're going to pay $4,243.75. So let's go back, and I guess to just finalize this case study here, we had $16,609 that they had to pay, which was 13.8%, right? Plus now we have to pay another $4,243.75, right? So we're looking at total $16,609. If you lived in New Jersey, you would pay $20,853, right? Which if we divide $20,853 into $120,000 times 100, their effective tax rate is 17.3%. Right? So what does this mean? That every dollar that they make, they have to put away $17.30. Every $100 that they make, they need to put away $17.30 into a savings account because that's what they have to pay the government. Obviously, you don't have to do that because it comes right out of your paycheck, right? If you're paying more than that, though, guys, pay attention. That means that you're getting a refund at the end of the year. And if you're getting a refund at the end of the year, you are messing up. A lot of people get excited about their refund. No, what you're doing is you're giving the government more money than you have to all year, and then they're just giving it back to you with zero interest. So let's say you have debt, right? And you're getting a $5,000 refund. That means that you gave the government $5,000 more. You could have used that $5,000, kept it in your pocket, right? That's over $400 plus per month that you're overpaying in taxes. So you could change that by going to your HR department and changing your W-4 form and increasing your allowances. If you do that, then you will lower how much money you're paying in taxes out of your paycheck and you won't get the refund. But now you'll have $400 more in your paycheck and you use that to pay down the debt that you have. If you have debt on credit cards and you're paying 15 or 18% interest, let's not let the government use our money tax-free, right? Or penalty-free, interest-free. Keep the money, pay down your debt, and it'll save you, right, all that money. It's crazy when people get a refund. It's like unbelievable to me that they're letting the government use their money interest-free. Meanwhile, they could be investing that money, right, or paying off debt. What do you guys think about that, right? Comment. Tag somebody, guys. Tag somebody that doesn't know this, right? If we're financially ignorant, how can we get ahead financially? How can we end up in a great place financially if we don't understand the rules of this game, right? The game of life includes taxes, whether you like it or not. But is this so complicated? Is this calculus? I mean, heck, in high school, you had to pass your math test. This isn't complicated. This is adding, subtracting, dividing, percentages, fractions. It's not that difficult. Look, and if you don't understand all of it once when we do one video, hey, welcome to the world. Everybody else isn't going to get everything the first time. I never get everything the first time I hear it. But you study it and you watch the video again and you're like, oh wow, I'm starting to get it. Ask your accountant questions, right? Be like, how'd you come up with that number, right? That number that I have to pay, can you explain to me how you came up with it, right? You should know this, guys, right? I hope this is really helping you guys out. This is why I'm doing this video, because I want you to understand this. I want you to be in it. Because if you understand how this works, you can change things around. You can be like, I really want to lower this number. I want to lower this number. Great, what do I have to do, right? I have to start a business. If I have a business, well, then I can have more write-offs. I don't have to take the standard deduction of $24,400. I can invest money in marketing. I can invest money in different things. My computer is now tax deductible. My printer and my ink toner is now tax deductible, right? Because I'm using it for business. My cell phone expense, a lot of that is tax deductible because I use a lot of it for business, right? There's a lot of things that you can deduct up to $10,000 your first year for startup expenses when you start a business, right? I can put a kid, if I had a kid on payroll, I could put a kid on payroll and I can pay him, right, up to a certain amount per year, where as an individual, you don't have to pay tax on your first $6,000 plus. So I could pay my kid $6,000, right? Or now the standard deduction for an individual is $12,000. So I can pay my child $12,000 for doing something in my business, stuffing envelopes, right? You have 2 kids, you can get $24,000 in write-offs. $24,000 in write-offs, right? And an effective tax rate of, 10%, call it, right? That right there saves us $2,400. If you're at the 12%, that saves us even more money, okay? So keep that in mind. Good stuff here, okay? Now, okay, we're gonna basically break down a couple other things. This is a little bit more complex, but it's gonna be really good stuff, right? So if we can check the screen out here. So if you're self-employed and you make $100,000 in profit, right? Let's say you're self-employed and you buy, fix, and sell houses, okay? You flip 2 houses and you make $50,000 each. and you make $100,000, right? Or let's say you make $60,000 on each one, and you made $120,000, but you had $20,000 in expenses, right? Marketing, your LLC setup, all this stuff, right? And you netted $100,000. Okay, so if you look at the screen here, you don't have now an employer. You're your employer, right? Because you work for yourself. That's why you're called self-employed. You have to pay 15.3% in taxes to Social Security and Medicare, right? The federal tax brackets are exactly the same, right? We would take our $100,000 in net profit, right? And we would have to pay taxes on that because that will roll down to us personally, right? If you're self-employed, right, that $100,000 is going to roll down to us personally. Now, if you're a sole proprietor or an LLC, right, it depends on how you're taxed. Okay, if you're a sole proprietor, you're going to have to pay 15.3%. But watch this. If you have an employer, right, you pay half and your employer pays the other half. Now, there's another way of doing it. There's something called being an LLC taxed as an S corp. Okay, so if you're self-employed, you pay $100,000. If you make $100,000, you have to pay the $15,300. But if you're an LLC that elects, okay, when you register an LLC, okay, you get to choose one of four options. One, you can basically get taxed as a sole proprietor, as an individual. Okay, two, you can get taxed as a partnership. If you have a partner, right, two people in one LLC, you could be taxed as a partnership. And then you're both gonna, all that money is gonna go down to you guys personally, and then you're gonna have to pay federal, Social Security, Medicare, and state taxes on that. Okay? Now, there's also two other options, S Corp and C Corp. Talk to your accountant about this. If you elect S Corp, then out of that $100,000, you're gonna pay yourself a reasonable salary. So if you look at the screen, okay, out of $100,000, let's say a reasonable salary according to your accountant is 30%. So 30% of $100,000 is $30,000, right? You would pay yourself a W-2 income of $30,000. So how does that work with Social Security and Medicare? Well, we already went through it. If you're employed, right, in this case, you're employed by yourself, right? But you're getting a salary. So you're an employee of your LLC. As an employee, you have to pay 7.65% of the $30,000. And then as an employer, you have to pay the other half. So you're still paying 15.3% on $30,000. But then the other $70,000 that's left over, you're allowed to pay yourself as a shareholder, right? That's called a K-1 distribution, okay? That $70,000 that you pay yourself as a shareholder, the profit, is not subject to Social Security or Medicare tax, which is called the self-employment tax, right? You don't have to pay Social Security and Medicare on that $70,000. So now you don't have to pay $15,300 in Social Security and Medicare taxes. You only pay taxes in the amount of $4,590. So it saves you $10,710 a year by electing to be an S Corp. Now this starts to really make sense once you're making over $50,000 in net profit. If you're making $50,000, if you're making less than $50,000 a year in net profit, it probably doesn't make sense, okay? Another thing to know is that the 7.65%, right, that your employer has to pay of the $30,000, because your employer has to pay half of your employee, right? Half of the Social Security and Medicare. So they're going to have to pay half of the $4,590. That's tax deductible. So you get to write that off. So that's even another benefit that you get. So if you're a business owner, if you're a flipper and you make more than $50,000 a year, one of the best things that you could do is set yourself as an LLC taxed as an S Corp. Now, talk to your accountants, right? Talk to your attorneys, right? I'm not an attorney, I'm not an accountant, but this is what we do to save money on Social Security and Medicare. You're not saving a whole lot of money, but in this case, you would save $10,710, plus you would get to write off half of that $4,590 that you paid, right? Which is pretty good, right? You're saving, $11,000 or so in Social Security and Medicare. In taxes that you might never get any benefit to. Right? In the future, I might not get any benefits to Social Security or Medicare. I know that I'm not counting on Social Security as part of my retirement plan, right? My retirement plan does not count that. Now, because of the tax reform law that the Trump administration passed, there's also something called the qualified business income deduction, okay? So what does that mean? Let me show it to you here. Here it is. So out of that $70,000 in K1 distribution, the shareholder profit, you're allowed to not have to pay taxes on 20% of that money. So 20% of $70,000 is $14,000. That's tax-free because of the tax reform, right? So that saves you a couple $1,000. So instead of paying taxes on the $70,000, you're only paying taxes on $56,000. And again, right? Are you allowed to have a 401k? Yeah, you can have what's called a solo 401k. You can have a sponsored 401k by my own company. If I have an LLC tax as an S Corp, I'm allowed to, guys, right, put money away. So look, let's say I put in $19,000 in my 401k as an employee, right? And another $6,000 away in my IRA, right? I'm allowed to do that. So I'm a flipper. I buy a house, I fix it up, I sell it. I buy a house, I fix it up, and I sell it. I made $120,000 gross. I had $20,000 in business expenses, so I made $100,000. And I paid myself a $30,000 salary as an employee. As an employee, I'm allowed to put $19,000 away in my 401k. And I'm also allowed to put another $6,000 away in my IRA. So what does that mean? That I don't have to pay tax on $25,000. Check this out. So out of the 30 grand, I don't have to pay federal taxes on $25,000. I only have to pay tax on $5,000 of it. Right? Look, if you're at a job, you're allowed to do the same thing. You could put $19,000 away at a 401k and $6,000 away in your IRA. That's $25,000. Okay? So I only have to pay tax on $5,000 of my W-2 income, federal taxes. I still have to pay the $4,590, right, on the 30 grand. Because that's Social Security and Medicare, that's off your gross. Remember, there's no deductions there. And I still do have to pay state income taxes, right, on the $30,000 if you live in a state, right, that charges income taxes. Then, okay, my employer, which is who? In this case, me, right? I'm allowed to contribute 25%, right, of whatever I paid my employees, right? I can contribute 25% towards their 401k. So in this case, I can contribute another $7,500, right? So look, $25,000 plus $7,500, right? I would basically essentially not have to pay any taxes. But the way it works is that $7,500 is a tax deduction for your employer, which in this case is me. So instead of having to pay taxes on $56,000, I deduct the $7,500 because I contributed to my employees, right, 401k, which is me. I can contribute 25% of the $30,000, which is $7,500, right? My employer, right, ABC Flipping LLC, right, is allowed to pay 25% into the 401k of the $30,000 that they paid in salaries, right? So 25% of $30,000, I can contribute $7,500 to my employee's 401k, which ends up in my 401k, right? Because I'm the employee. And then my employer, which is me, gets to deduct the $7,500 contribution because it was an expense, right? So instead of paying tax on the $56,000, right, I don't have to pay tax on the $70,000. Why? Because the Trump administration said I can reduce it by 20% of qualified business income, right? So I'm at $56,000 in taxable income. But then I get to subtract another $7,500 because I contributed to my 401k. So I only have to pay tax on $48,500 in my business and then $5,000 as an employee. Pretty cool, right? That's only $53,500 that I have to pay in taxes, but I made $100,000. I still have to pay taxes, right? I can't get away with not paying any taxes. The only way to get away with not paying any taxes is if you don't make any money. I know how to do that, right? I can make money and then spend all the money on tax deductible expenses. So for example, like, let's say I hired an employee or I hired Joshua Productions and I said, hey, Joshua Productions, let's make a movie, right? And they're like, all right, the movie you want to make costs $100,000. If I made $100,000 that year, but I gave it to Joshua Productions, that's 100% tax deductible expense, right? Because it's for marketing, it's for videography, all that stuff. So I wouldn't pay any taxes. But guess what happens? Then Joshua Productions got that as income. Because in order for me to deduct it, what do I have to do? I have to 1099 him. I have to tell the government, hey, you know, I paid this company $100,000, Joshua Productions, right? So I don't have to pay taxes on it. Because if I made $100,000, but I gave it to somebody, and that's a tax deductible expense, I pay 0 taxes. But now who has to pay taxes? Joshua Productions. Joshua Productions has to pick it up because they got a 1099 for $100,000, and now they have to pay tax. So the government didn't lose. Hello. If somebody doesn't pay taxes, it doesn't mean that they didn't create a taxable event, right? I can make $1 million, spend $1 million, but whoever I spent it on, they have to pick it up as income, and then they have to pay taxes on that money, right? So like all these articles that you see about Amazon making $1 billion or whatever, and then they didn't pay any taxes, that doesn't mean anything because Amazon created an unbelievable amount of taxable events. Because of them, the government's making a lot of money. If they did not exist, and look, if you really think about it, that's the IRS's rules, that's the government. The IRS made those rules. You think it doesn't benefit them? You think the rules doesn't benefit the IRS? Of course it does. They want to incentivize me to hire Joshua Productions. So they say, if you hire Joshua Productions, right, for $100,000, you don't have to pay tax on $100,000. Why would they do that? Because they know if I hire Joshua Productions and I make a movie, right, eventually on that movie, hopefully I'll make money. If I make $1 million on that movie, right, or on the videos and all the marketing that we did, if I make $1 million on that, then I have to pay tax on the $1 million bucks. And they still get the tax money from Joshua Productions because if I give them $100,000, they have to pay taxes on it because they need to pick it up as income, right? Obviously, they can deduct their expenses. If they buy a hard drive for $3,000, they deduct the $3,000 from the $100,000. If they buy another camera for $10,000, then they deduct that. But if they pay $10,000 to a camera company and they get deducted, the camera company has to pick it up as income. Is the IRS losing? No, the IRS doesn't lose. Okay? So everybody that's saying, oh, this guy, this company, that company doesn't pay taxes, here's what you have to ask yourself. And this is what everybody should be talking about. How many taxable events are they creating? And I have news for you. They're creating more taxable events than you. So if they paid zero in taxes, Amazon, they actually made more money for the government than you, even though they didn't directly pay it. All right, guys, so now we're going to shift gears a little bit. Now we're going to talk about another case study real quick. Hopefully you're learning a ton on how to save money on taxes and how to actually calculate your taxes, right? You can write off a bunch of stuff if you have a company. So talk to your accountant. Hey, does it make sense for me to have a company? Does it make sense to put my kids on payroll? Does it make sense to put more money in an IRA or a 401k? Now check this out. This is going to blow your mind. You are going to be shocked by this, okay? Because it is, if I were to do what I'm about to do, if I did this on national television, I think people would flip out. I think they would go nuts because it is the opposite of what everybody kind of talks about. Literally the opposite. So check this out. Let's say you have a single parent, right, with 2 kids. That would be called head of household. Right? And let's say that person, right, has a job, right, and they make about $50,000 per year salary. Okay? Perfect. So the way that this would work, this is going to blow you guys away. So check this out. So the way that this would work is, right, so just think about head of household. They have 2 kids, right, under 18 years of age. They make $50,000. So now we're going to go over here. Their standard deduction as head of household, if you see right here, it's $18,350, right? So what we would do is we would take $18,350, right, from the $50,000. You say take $50,000 minus $18,350. So we're left with $31,650. Then, assuming that they don't put any money towards IRAs or 401ks, right, because they don't make enough money. They only make $50,000, right? We're going to go to head of household, and this is the tax brackets. So then if they're at $31,650 in taxable income, what we're going to do is we're going to find the bracket, right? So the bracket is number 2. So from $0 to $13,850, they paid 10% on that, which is this $1,385, right? And now we have to pay 12% on everything above $13,850. So their taxable income is $31,650. So what we're going to do is we're going to take $31,650, we're going to subtract $13,851, and that gives us $17,799, which that's $17,799 we need to pay 12%, right, of federal income taxes on. So we're going to multiply times 0.12, and that gives us $2,135, right? And then we're going to add the $1,385. That'll give us their taxable income. So their taxable income is $3,520. So we're going to go over here. taxable income equals $3,520 and 88 cents if we want to be exact, right? So again, head of household, 2 kids, right, making $50,000 per year, right? We subtract the $18,350 from that, right? It gives us their gross adjusted income, and then we go to the tax brackets, and this is what their tax bill is, right? Their taxable income, right, at the tax brackets, will be a $3,520 tax bill. Now, just like the scenario before that we were discussing, if you have 2 kids, how many credits that you get? You get $2,000 off per child off your tax bill. So our tax bill is $3,520, right? But we get $4,000 off. So we actually make $480. So, obviously they probably get paid once a month or every 2 weeks. And if they do, there's deductions that come out of their paycheck, right? Well, they would get all that money back, plus they would actually end up with $480 ahead. So what does that mean? That they pay $0 in federal taxes. In fact, they made, right, $480. So this person with 2 kids pays no federal taxes at all. Now, what's interesting about this is this person has been convinced that other people in other tax brackets should pay more federal taxes, right? Like people in my tax bracket, they should pay more, they're saying, even though they pay no taxes at all, and they're actually making money in the amount of $480. Now, this person still, has to pay Social Security and Medicare, which hopefully will be for their benefit in the future. And if they live in a state that has state income taxes, they're also going to have to pay that. But what's interesting about this, and this is the exact opposite of, like I was talking about before, the media and basically, articles and things like that, they portray that the rich don't pay taxes, that people that make a lot of money don't pay taxes. And we talked a little bit about Amazon in this video and how that works with taxable events. And it's just really, really interesting that I'm not sure if these people even know that they're not paying taxes, right? And maybe they do. Now, I don't think that they should have to pay more taxes because they can't afford it, right? A single parent with 2 kids making $50,000 a year, I don't think that they should be paying more taxes. But what really boggles my mind is that they're convinced that other people should pay more federal taxes because they think that they're not paying. And I think if they were educated that they get the same services, sometimes even more services, but they're not paying any federal taxes at all, I think if they were educated about that, then they would change their perspective a little bit. My take on everything is, let's not charge people that create jobs or make more income more taxes. They're already paying their fair share. If you look at the tax brackets, you would see that, right? They're paying, sometimes over 37% in just federal income taxes. But let's really police and audit how we're spending our money as a country, right? We're bringing in trillions of dollars in revenue. How is that money really being allocated? How much of those tax dollars are really being used efficiently, et cetera, and really drilling down on that, right? Kind of auditing, how we're spending our money. So that's basically how it works. Now, if we're going to continue on with this conversation, let's see how much this person really pays in taxes overall, right? So they're going to have to pay 7.65%, right, in Social Security and Medicare, right? So if you take, their gross of $50,000 and we multiply times 0.0765, right? That would be $3,825 plus New Jersey state income tax. I already did the numbers, and New Jersey state income tax for this head of household bracket at, the 50,000, minus some deductions. I used $40,000 as their taxable income for the state of New Jersey, would be another $630 that they would have to pay to the state. So if we add those two together, plus $630, that would be $4,455, right? But they got back, they made $480. So if we subtracted $480 from this number, they actually paid total taxes, and this includes federal Well, federal, they didn't pay anything, but Social Security, Medicare, and state in New Jersey, their total tax bill is $3,975. And if you divide that into their gross income and multiply times 100, right, they paid 7.95% total in taxes. So probably less than what they thought they paid. If you ask somebody that makes $50,000, you say, hey, how much money do you think you pay in total taxes? They might say 25% of my income or 20% of my income or half my money if they were being really dramatic. So that's a little bit about that. In this next example, I'm going to talk about real estate investing and if you buy, fix, and sell houses. Okay, so one thing that's important about this, if you fall into this category, right? If you're a single parent, you have a couple kids, and of course, guys, like I said, I'm not a CPA, I'm not an accountant, but what you should do is two things, okay? And like I said, talk to your accountant before, because you might not have the exact income of $50,000 or whatever the case. One thing that's really important is you should increase your allowances at your job. That's called the W-4 form. Increase your allowances, right? Like we discussed. And all you have to do is call your HR department. Why do I say that? Because you shouldn't be paying taxes to the government every 2 weeks or every month or whenever you get paid and then get a refund back at the end of the year, because you can use that to improve your cash flow and also to pay down any debt that you may have, okay? And number two, this is a big mistake that I think a lot of people make in this tax bracket. You are not paying any federal taxes. So it might not be a smart thing to do to put money into a 401k or in an IRA that's tax deferred. Why? Because the whole idea of putting money into a tax deferred account is so you don't have to pay federal taxes. Well, you're already in a scenario where you don't have to pay any federal taxes. So don't put your money in a 401k or IRA that's tax deferred. Put it in what's called a Roth 401k or Roth IRA so you can let that money grow tax free and build up a retirement where you don't have to pay any taxes at all in the future of that money. Right? So, and any of that growth. So if you had the money to put in, $5,000 more in your Roth IRA or Roth 401k, that money, if it grew to $50,000 over 30 years, then you can pull it out tax-free after 59 and a half years old and pay zero taxes on that money. How awesome is that? So talk to your accountant. Hey, is it going to benefit me to invest in a tax-deferred account, or should I put it in a Roth? That's a really good tip for you guys. So that's a little bit about how that works. Now, if you're an investor and you flip a house, I want you guys to understand that you are going to pay what's called a short-term capital gain, right? If it's 12 months or less that you buy a house, fix it up and sell it, and you make $50,000, right? This is a short-term capital gain. It's going to be added to your taxable income. Now, if you have 12 months, right, and a day or more, right, 12 months or more, you have to pay a long-term capital gain. Long-term capital gain. Okay, you don't pay the ordinary federal income taxes. So how does that work? Let me show you. On my slide deck over here, let's see here. This is how it works. So you pay 15%, right? And there's different brackets. Again, if you're an individual, if you're married, if you're head of household, right? If you make over $434,550, you're going to have to pay 20% on that $50,000. That's $10,000, right? If you make less than that, right, up to $39,375 for the year. If you make $39,375 or more, you're going to have to pay 15%. And if you make more than $434,550 as an individual, you're going to have to pay 20% on that, right? So that's how it works. So if you hold a property for 12 months and a day, right, you're going to pay a different tax bracket, either 0, 15, or 20. That's how it works, okay? Here are some resources for you guys to look at the deductions. So you could take a screenshot of this on the video, and this shows you what the individual deductions are and credits, right? Credits and deductions for individuals. This is deductions for businesses, and then this is the small business self-employed home office deduction. So you can actually deduct a piece of your home, a percentage of your home. So if you have a 2,000 square foot house, but you have a home office that's 200 square feet, you can deduct 10% of your expenses of your household because your home office is in your home, right? So that's some tax knowledge for the day. Pretty long episode, I think, right, Joe? I want to announce some of our sponsors because they always help us out in a lot of the things that we do. Like I said, I run the New Jersey Real Estate Social Network. And if you're a flipper, it's really important for you guys to get some capital, right, for your flips. Alpha Funding actually finances up to 90% of the purchase of a property. So if you're buying a house for $200,000, they'll finance up to 90% of the $200,000 plus 90% of the construction on that property, right, for really good rates and fees. So definitely reach out to Alpha Funding or go to alphafunding.com. Freedom Mortgage does traditional mortgages. So if you're in the real estate business, or if you're looking to buy investment properties, or just a house to live in, or to refinance your house, Freedom Mortgage is licensed in a ton of states. Definitely reach out to John Palumbo via email, or that's his phone number. You can give him a ring over at Freedom Mortgage. And Signature Realty, this is my company with my wife's company. We did $200 million in sales last year, 500 transactions. We have over 100 agents now. And if you're unhappy, if you're a realtor and you're unhappy where you are at your current brokerage, reach out to us. Go to signaturerealtynj.com, go to the careers page and put in your information, and we'll reach out to you for an interview. We do a ton of training for our real estate agents. We have a commercial department. Of course, we have a residential department. And we do first-time homebuyer seminars. We do bus tours. We really educate the public. That's why I'm doing this one-on-one with Jon Steingraber. And that same message of seek to serve and educate people, we use that over at Signature Realty NJ. So that's what we're all about, really helping people understand the real estate, home buying process and home selling process. And then we have Joshua Productions. They're obviously doing this show. Anything that you guys need for videography, home tours, if you want to tell a story on video, whether it be of a house or a business opportunity, or you want to do a commercial. They do a ton of commercials for business owners, and it's really, really awesome. And then we have Next Generation Investment Group. This is my good friend, Michael DeFrenza. We both are partners in this company, and it's an alternative investment fund. We offer a fixed 15% return on investment. So if you're interested in putting some of your retirement money to work, or if you're looking to put some of your cash to work at a very high double-digit rate of return, we offer a fixed 15% annualized rate of return, and it pays out every 6 months. So if you invest $100,000 as an example, you get $7,500 right in dividends every 6 months, and that is not taxed Social Security and Medicare. You don't have to pay any taxes on Social Security and Medicare on that income. You only pay your regular dividend income tax on that, your federal income tax. No Social Security, no Medicare. So that's a really good way to make your money work for you. If you're interested in that, reach out to Michael or myself. And hopefully you guys enjoyed this episode. Definitely comment, tag somebody, share it, and show me some love. Heart it. If you were really surprised, put the little emoji wow if you're watching this on Facebook. And if you're watching on YouTube, subscribe on the button above. And if you're watching anything on Instagram, hit the 3 little buttons and put turn on notifications so you guys get notified anytime we upload something on our one-on-one Jon Steingraber Instagram. Thank you for watching. Check out our other videos. They're super informative, super educational. And if you're in the New Jersey area, remember to come out to our real estate club events and workshops. Visit njresn.com for all those event dates and times and locations. Thank you very much. I'm looking forward to reading your comments on this one.